Today is Wednesday, April 1st, and our topic today is stock option strategies for when the stock market is in the toilet, which, as you know, is a highly technical financial term. So you know that if we're saying it, it's true. And joining me today in this conversation is a fellow practitioner, Aaron Rubin, who will take us on a deep dive journey into the mysterious world of stock options. Aaron is an attorney. He's a CPA, a CFP, which is a certified financial planner. He graduated with a degree in economics, accounting, Spanish literature from Claremont McKenna College. He then went on to law school at the University of Illinois, where he graduated cum laude. And then following law school, he worked for 3 years in public accounting. And then he started working at his current firm, Werba, Rubin, Papier. I hope I said that right. We'll call it WRP from now on, where he is now a partner. Now, WRP works primarily with people that have pre-IPO stock options, and they do a lot of financial planning, investment work, and tax planning work around those options. And what makes Aaron's perspective, in addition to the financial planning and the investment work around stock options, they also have an in-house tax practice, which helps to look at the options from another tax perspective, which is incredibly important. And so with that, I would like to welcome Aaron to our conversation. Aaron, can you hear me?
Yeah, I got you. Yeah, WRP sounds good. Let's stick with that.
Well, tell us the right way to say it, because I'm sorry if I butchered it up.
It's all right. It's Werba, Rubin, Papier. So I commend you for the effort.
Thank you. Well, it's almost as if you're speaking French.
Yeah. And thanks for the invite today. I actually very much appreciate it. Great chatting with you.
It's great to have you. So with that introduction being said, the topic today, of course, is various stock option strategies when the market's in the toilet. And so with that being said, what can folks do with stock option planning in this proverbial market being in the toilet?
Well, I think there is a lot of opportunity, to be honest with you. When you look at, in our world, there's two different types of stock options, those that are pre-IPO and those that are publicly traded. And to start with the publicly traded, because it's just a little easier to understand, essentially stocks, and it could be even, your particular company, if you're at a publicly traded company, are at a 30% discount. And so there's an opportunity there. If you are going to exercise your options anyway, several weeks ago, and hold them, you may as well do it now. If your options are at a 30% discount, you can essentially take the amount you would have had to put in wages by exercising, let's say, a non-qualified option. And then you can turn around and you can, if you wait for a year and the stock comes back to where it was, you can change that 30% delta into a capital gain, which gives you preferential rates. So I think that's a big thing. And if you have incentive stock options, which normally aren't in regular income tax, but are a component of alternative minimum tax, you can stuff more shares into your exercise, AMT, free, or maybe paying less AMT. So again, on the publicly traded side, there are lots and lots of opportunities. And in that same vein, there are also a little bit more advanced estate planning opportunities when you look at it. If your stock comes back in a year, and again, it's a big if, I can't guarantee anything, but if that stock comes back and you're looking at really low interest rates, you can really make some hay if you're going to start using things like charitable lead annuity trusts, which are interest rate dependent, and the lower the interest rate, the better the deal is for using those types of vehicles. So again, your stock's in the toilet, it's publicly traded. There's two things to take a look at right there that could really help you out. On that pre-IPO side, it's definitely more difficult. For pre-IPO, there is no readily available fair market value because they're by definition not traded on an exchange. So what that means is you have to rely on the 409A valuation. And your 409A valuation is a IRS required valuation that happens either one, when there's a new round of funding, or two, there hasn't been a valuation done in a year. And by law, you use that 409A to determine the strike price of the stock options that people are going to purchase for the new grants. But many companies use that 409A to also determine the fair market value when someone who has a pre-IPO stock is going to go ahead and exercise that stock, whether it be a non-qualified option or an incentive stock option. And so if you recently had a 409A on your company done, let's say January or December, you could be looking at a much higher valuation when you go to exercise than really what your company's worth right now. And it's worth really thinking about waiting to exercise options if you had a recent 409A, just because it could be in, and again, I can't predict the market, but it very well could be in the next couple of months that a new valuation may come out that will be much lower, that will let you take advantage of those things that those who do have publicly traded stock do, right? That there is a lower valuation, that maybe the valuation is 30% off. And it could be even higher. I know that small cap stocks have been hit disproportionately during this recent downturn. I guess at some point they were down 50%. So again, if you can get a huge, big savings, on that tax bill right now, you may really want to think about it. Now, if your company's taken off like a rocket anyway, maybe it doesn't really matter all that much. But again, if you can, it's something to seriously consider. Go ahead.
Well, I was just going to ask. I mean, we dove in, and I feel like I'm swimming now fully in the world of options. But if we were just to take a step back, and I know that a lot of folks often are unclear about the type of options they actually have and the difference in how they're treated. From a 30,000-foot view, can you tell us the difference in the types of options there are and sort of delineate between those that are in publicly traded companies or those that are still private? And let's start there.
Yeah, sure. Yeah, no, there's a lot of alphabet soup that happens with options. So it's a difficult thing to sort of master. But in the pre-IPO world, especially on the earlier stage companies, your choices generally are incentive stock options called ISOs or non-qualified options, NSOs. And they have similar features with different tax consequences. So the idea behind a stock option is that you have a strike price, that which you are going to pay for it, and then there's a fair market value, what the actual option is worth. And in between that delta between what it's worth and what you paid for it, it's called the bargain element for those tax wonks. And the bargain, and when you exercise an option, if it's an ISO, for regular income tax purposes, that paper gain doesn't involve any tax. But unfortunately, in this country, we actually have two tax systems that operate simultaneously. One of those is the regular tax system, which we all know and love, and they have the 0% bracket and the 10% bracket, 12, all the way up to 37%. And we know and love that one, and it's more familiar to us. But in addition to that, there's a secondary type of tax, and that's called the alternative minimum tax, AMT. And what the AMT does is say, well, all those income and deduction items, that's all nice. But we're going to make some adjustments. We're going to say that things that we didn't include in income, we're going to include things that we are now going to include in income for AMT calculation purposes, and things that we were allowed for deductions on the regular income tax. Well, we're not going to allow those anymore. And those are called adjustments and preferences. And you work through those, and eventually you get your alternative minimum taxable income. Then you get two rates, 26% or 28%, very flat tax. So people who enjoy Ross Perot, I guess, are big fans of the AMT. And you take the greater of the two between the AMT and the regular tax. Now, going back to that ISO, the bargain element for ISOs that we said wasn't includable for regular income tax is includable for AMT. So you can run yourself up a really nice tax bill just by purchasing the stock. and not really realize it. The non-qualified stock, similar to the ISOs, but when you exercise the non-qualified stock, instead of it being an AMT adjustment, it actually ends up being part of your regular income tax. And it goes right on your W-2, payroll tax, the whole 9 yards. And so when you exercise those, you got to come up with the cash to pay for the option itself, and then you have to pay the tax from your wages. And it's true for whether or not you're at a publicly traded company or a pre-IPO company. You see those options more at pre-IPOs, especially the incentive stock options. Old timers at publicly traded companies may be still hanging on to some of those non-qualified options. But many times at the more mature companies, you end up seeing restricted stock units, which are, again, a different animal unto itself, where it's a restricted stock unit is basically a bonus you get, but just so happens to be paid in stock instead of cash. But again, there's not a lot of maneuvering you can do with those RSUs, to be honest.
So
go ahead.
If I'm hearing you correctly, then folks that have particularly those stock options more so than the RSUs should really be thinking about what ways they can minimize the tax hit, if you will, based upon the prior valuation of their stock.
Right. And really take a step back and think whether or not, and again, part of it's, a scientific wild ass guess, right? Is the company valuation going to go down? Mm-hmm. Even though it's down, do I still believe in the company and think that I can get this stock at a much better price and that it's going to recover, soon after? It's a hard thing, right? And part of it is, some of it is faith, but some of it is numbers. If you think you have a company that's viable, if it was viable 4 weeks ago, it very well could be viable in the future. And if you can get the price for 30% less and maybe you have to wait on a new valuation, you do it. And again, there's opportunity there.
So if, let's say I'm listening to this conversation, I've got a lot of stock options that I'm not quite sure what to do with. I just am looking at the stock price of the company that I work with or for, and it just keeps heading down. What would you recommend I do at that time?
Right. So if you're in a publicly traded company, mm-hmm. And you have cash, and you want to try to leverage that cash, buying those stock options now, again, if it's a non-qualified option, you got to make sure you have the money to come with the tax mm-hmm. on those options. Because again, if you can hold on to those options for a year, you can take that 30% discount, change it from something that would have been included in your W-2 and change it to something that's long-term capital gain, which is a preferential rate. Mm-hmm. So I think that's one. If you're sitting in a non-publicly traded company, a pre-IPO company, you really have to wait on that 409A valuation, and hope. It could be that the board maybe makes an adjustment mid-year. Maybe that's possible. Mm-hmm. Otherwise, you're kind of stuck. You're in a bit of a holding pattern, and you really got to think. If your 409A valuation came out, month or two ago, do you really want to pay that premium if you feel pretty certain the valuation is going to be lower? Again, it's a feeling, but it could mean a lot of money to you.
Can you take just a couple of minutes and go over what is the 409A valuation for those folks who may not be as familiar with it?
Yeah, so the 409A valuation is in the Internal Revenue Code, and basically what it says is that if you are a non-publicly traded company and you have and there's no readily ascertainable value, you have to find the value, and there is no requirement that you work with a third-party valuation type entity, and I'm assuming that if you're in the seed round, maybe you don't spring for that. But most people tend to use a third-party valuation just because it gives them some cover in case the IRS comes knocking and says, "Wait a second, you gave all your all your top executives this value when the value was really 3 times the amount. And so, again, when you use that 409A specifically to determine the strike price, so that the compensation is fair to your executives and your early employees. And then a lot of companies choose to use that 409A valuation to determine what the fair market value is, perhaps for 12 months, which of course seems a little silly, but know what, you don't want to keep paying for 409A valuations every month. So, and on the fair market value, you're not required to use the 409A as the fair market value, but I think a lot of companies tend to, just because again it's that third party, you get to lean on it, and it looks reasonable from an IRS perspective.
Gotcha. So if let's say I'm either involved with, or I myself am a founder or one of the co-founders of a startup, we're non-publicly traded. It may have been a while since we've done our 409A evaluation. What things might you recommend then to a person that holds a high concentrated position in their company stock right now, based upon where we are in the marketplace?
Yeah, well, there again, tons of opportunity. Obviously, what you need to be aware of is, depending on how early on you are in the company, or how young the company is. As companies mature, you tend to get more and more restrictions on transferability of stock. So you end up being a little more limited, as things get bigger. But when it's still small, you still may be able to do some really interesting things with transfer. So if you think, you still have a great product and it's still going to go crazy, in 6 months, maybe you start talking to estate planning attorneys and you start thinking about doing grant or retained annuity trusts and trying to take that value, that's now 30% discounted, again, depending on what your 409A says, and put it into a trust that will let you pass it on into the future, get it out of your estate, and really do some advanced planning with it. So yeah, if you got the opportunity, now's the time to do that sort of stuff.
And if this is now again the same situation, but now we're working for a publicly traded company, and I've got whether they are stock options or RSUs, the value of the company is down just because of the stock price. What would you suggest that we do?
So if you're sitting on RSUs, if you're getting the grants, right? The grants are based upon the fair market value on the day of the vesting, and whether or not you take those grants and you turn them into cash and put them into a diversified fund, or whether or not if you really believe in your company and you think it's going to do better than the market and you want to stick with it, again, far be it for me to tell you what to do, but the idea is that if you're getting the grant on the RSU, you might as well take the cash. There's no real reason not to, because you're going to get taxed on it. You can't unring the bell. You can't go backwards and say, can you please vest 5 weeks ago? That just isn't the way it works. So you're kind of stuck on that RSU side. If you're sitting in non-qualified options and you have cash, as I said, now might be a really interesting time to exercise those options, as long as you have the cash to pay the tax. Hold on to them. You could, again, if you're willing to put into it like a charitable lead trust, you can get a big tax deduction. If you wait for a little while, price comes back. In a charitable lead trust, the lower the interest rate, the more charitable deduction you're going to get. So again, if you're charitably inclined, now's a good time to do something like that.
And I appreciate you bringing that up, because I find that when individuals that have concentrated stock positions generally come to a financial advisor or a financial planner, most of the advice is around the investment management piece. Sometimes it's around the overall financial planning piece. How does this decision of what to do with the stock relate to or affect your overall big picture planning? But I think it's so rare where that same person in that same conversation would take a different perspective and look at all the tax planning that can be done. So I really appreciate that you do that, and the fact that you've got an in-house CPA firm or tax firm that can do that. You yourself is a CPA. Are there any additional tax either issues that people should be concerned and thinking about, or additional benefits that they can get from where we are in this market when it comes to tax savings?
Yeah. Oh my gosh. Another fertile area, right? To talk about where you can make some hay.
We've got
Uh,
3 hours. Go ahead.
okay. Yeah, I'll give a little seminar. Why not? Uh, yeah. When you're looking at the tax piece of it, if you're in a really low income year right now, for whatever reason, you might be able to exercise some of those non-qualified options for a lot less for that tax bill. So again, part of that is going to be working with your tax professional, making sure that you're getting some really good projections worked in, and again, yeah, every quarter you should be checking in if you're going to start doing kind of some of those more advanced planning type pieces. The What'll be interesting is that for us in our firm, we are, because we're so tax focused, we tend to think a lot about tax loss harvesting strategies, active tax loss indexing, which is kind of taking essentially building your own index and trying to get tax losses out of it while gaining the market, whatever the market's providing to you in terms of return. And when you're in a really and when you're in a bad market, there isn't as much opportunity once the market's fallen by 30%. Hopefully, not a lot more opportunity, right? But there isn't as much opportunity to harvest those losses going forward. So, we'll see what the future brings on that. But yeah, and if you've been holding on to stock, let's say you had the RSUs, they vested in January, and then all of a sudden, they're worth 30% less. And let's say you have ISOs sitting on the side as well that have capital gains baked in. Well, now is a good time to sell those RSUs, take the capital loss, use the capital loss to offset the ISO capital gains, and save yourself a bunch of tax in the process.
So this is very helpful, and it's a little bit like drinking out of a fire hose.
Yeah, I'm sorry.
No,
Sorry.
I don't think you've got anything to apologize for. It's a dense subject, and it has so many nuances, and it's important to be talking to somebody that understands how all of those different elements are interrelated and how they work with one another. So I appreciate that you're here talking about this. But if somebody's listening and doesn't necessarily know how to put all that in the right context, are there some good resources, whether that be on your website or others that you recommend, that people just begin to acquaint themselves or answer some of the questions, or follow some best practices that you just called out to?
Yeah, so our website, Werba Rubin Papier, WRP Wealth.
See, you even got it yourself. All right, let me put
Yeah,
that up on the screen. What's the address? www.
WRPwealth.com.
Okay.
We have if you go under insights, we have a blog, and we spend a lot of time talking about pre-IPO stock option opportunities and complexities there. And we have many blogs, and as I said, I could go on for a while talking about this, but I'll be merciful. And then our WRP tax is our other website for our tax practice, and we have some information there for people. It's a little more general in nature, but if you're looking for other types of information on pre-IPO or taxation of stock options, I'm a big fan of mystockoptions.com. They have a seminar they run in. They usually run it once a year in San Francisco. I think they canceled it this year for obvious reasons, but that's a really helpful website with some great FAQs in there. Also, big fan of Stock Options Council, a woman who works with executives and their compensation as it relates to I think mainly pre-IPO compensation, but it's another great website that we use when we have questions. So I would say there are some great resources out there. A lot of people don't don't talk a lot about pre-IPO options because there's a lot of complexity, and especially in what I didn't even talk about, what happens if you don't have the money to exercise, right? And there's all sorts of lending options. And again, I'm not gonna bog you down there. You can read more about that at our blog. I'm gonna correct one thing on your screen though right now, or else I'll get in trouble.
Okay, what is that?
It's papier, Papier. It says paper. So my partner Jason would slap me around if I didn't say something. There we go.
Tell him it's my fault, so it's on me. You're safe.
Right. Perfect.
Thank you for correcting that mistake. We certainly don't want to make those mistakes on the name of your firm or your partners. So you've mentioned, obviously, there's a whole wealth of information out there, and this is a complex area of planning, both from the investment, personal planning, and tax perspectives. You've given us some good websites, including your own website, and there's an insights or a blog that people can go to. If people have questions, would it be okay to display your email? Can they reach out to you?
Yeah, absolutely. We're happy to help.
Let me put that up on the screen. And this would be a good time. Tell us, when should people think about reaching out to you?
I think if you're on the verge of actually making a big exercise, that's important time to reach out. I think if someone starts talking about things like, oh, do you want to make an 83B election? You need to have competent people advise you on that. Even if it's not us, even if it's a CPA you trust and who knows about stock options, it's important. So if you hear things like 83B, if you hear things like early exercise, then it's definitely time to call someone. And then when the new 409A comes out, that's a good time to start thinking about maybe doing some tax planning as well. And again, seeing what opportunities are there for you.
And so along those lines, because you guys do in-house tax work, is it necessary for someone to bring their tax business to you guys? Will you help advise them on their stock options and work with their existing CPA, or can they come to you and ask you to handle the whole thing?
Either or. We have clients that will use us, just for the tax piece because we have that specialty, and then we have clients that just use us for the financial piece. But I think a lot of people enjoy having that the tax people talk to the financial people and kind of have that coherent plan, especially when it comes to something as specialized as pre-IPO stock options.
That's great. I say this from both the the insider perspective as well as from the outside looking in. But as a financial planning firm, caution anyone that has a concentrated position to pay some attention to that part of your financial life. Speak with the right experts, and I think that you would be in good hands reaching out to Aaron and WRP Wealth. So. Thanks again for being here. Do you want to leave us with any final thoughts?
Yeah, I guess I'll just summarize, right? If you're in a publicly traded company, you can buy your options at a discount, get capital gains treatment when it would have ordinarily been wages. You could also do some fairly interesting things on the advanced planning side. And then if you're a pre-IPO, you really got to consider waiting for that new 409A and kind of see what happens. So. Yeah.
Great. Well, thanks for coming and talking to us today. I hope folks had appreciated learning some tax planning tips and how to better navigate this crazy market that we're in, and hopefully not make too many expensive mistakes and come out all right on the other end.
Yeah, and I'm just hopefully I didn't confuse people more than when they came in. So. But if they have any questions, they have my email there. I'm happy to help.
Excellent. Well, thanks again. Be well, be healthy, and we'll talk soon.
All right, excellent. Thanks, Roman.
Take care.